Netflix reported earnings after the market closed on Thursday, and I think the big takeaway from the quarter is this is a company that just continues to march forward, continues to add subscribers, continues to push a little bit on their pricing power that they have in the market. If you're familiar with my thoughts on streaming in general, I think the way to think about this industry is with the smiling curve, where you're going to have companies that reach scale. They're going to have both more subscribers and more pricing power because they're going to be able to afford better content than their competitors. And that's going to be a flywheel that's just going to continue to help companies like Netflix over and over again. So they're going to be able to buy the best content, which is going to attract more subscribers, which is going to make their product more valuable. You see how this works. It just keeps getting better and better for Netflix. Whereas if you're a company like Max, for example, where you have a ton of financial problems, you're not able to pay for something like the NBA. That is something that could attract subscribers. So you're going to actually lose subscribers, lose pricing power. That's why the smiling curve makes a ton of sense. And with that context, that's how I'm looking at the recent earnings report. We're seeing revenue growth actually exceed subscriber growth. That tells you that Netflix is getting a little bit of either pricing power or their advertising is working. So let's dig into some of the numbers and show where there's some points of strength and where there's actually some points of weakness as well for Netflix. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's dig into the results. Now, as I'm recording, the conference call has not been done yet, so we don't have commentary from management. But I think the general trends to take away here are you have revenue growth of 15% in the quarter, but the number of subscribers increased just 14.4%. So again, on a global basis, and this does include currency fluctuations as well, you are seeing a little bit of more revenue per subscriber. That's the kind of leverage that you want to see Netflix taking into account. Same thing is happening on the bottom line, where they're just not spending as much on content. They have talked about this, and basically everybody else has in the industry as well. Everybody would love to sell their content to Netflix, but Netflix is going, hey, we're not going to overpay to just buy everybody else's content and keep all you guys afloat. We're going to be more judicious in what we're going to acquire in the market. So they generated $2.2 billion in free cash flow in the quarter and are now buying back stock at a pretty steady clip as well. But once you get down to the regional numbers, this is where I think things get a little bit more interesting for Netflix. This is the United States and Canada. And this is, I think, really the core from a financial perspective for Netflix. This is where you're going to have the best pricing. This is what's generally going to generate the most revenue and free cash flow. So that's what we see here. Revenue is up to $4.3 billion from $3.7 billion just a year ago. The number of subscribers also up over 7 million to now 84.8 million. Additions are slowing down. That is something that's going to be fluctuating, especially they came out with that ad-supported tier, that little bit lower price point. So any customers you may have attracted then, same thing with the password sharing crackdown. That was a boon for the number of subscribers that they had. Even if there weren't actually more people, there were actually more people paying for the service. So we're starting to see some of those things wear off. Management has said that, hey, what you should really focus on is the revenue number, not just the subscriber number. But they are also generating more revenue per subscriber. So again, price is going up a little bit, a little more advertising revenue, both good trends for Netflix. But that's not what we're seeing around the world. And you can see Europe, the Middle East, and Africa, revenue is up 3.1 billion from 2.7 billion a year ago. Paid memberships are up even more than that, up almost 13 million to now 96 million. But the revenue per subscriber, just $10.99. That's up only a penny from a year ago. Again, like I said, some of this is going to be due to currency fluctuations, but we're not seeing that much strength. And this is on a FX neutral. Revenue is up just 1% for the average membership. So that's a little bit of weakness that we have. So strength in North America, basically. Revenue per user on a currency neutral basis. Obviously, that is going to be currency neutral. Up 5%, up just 1% in EMEA. Latin America, a little bit different story. Here's where currency gets really wacky. Revenue increased slightly, 1.1 billion to 1.2 billion, but now we have revenue per membership declining to $8.40 on a year-over-year basis. That's negative 5%. That is in US dollars. But on a currency neutral basis, revenue is up 27%. So again, a little bit confusing numbers, but this is a US company. So at the end of the day, you want them generating US dollars. That's what's down 5%. So I think that's probably the more important number here, especially when you're talking about places where inflation and currency devaluation can be really, really rapid. I would pay more attention to this year over year number. And that's where we're just not seeing the same pricing strength that we are, particularly in North America. APAC, you see a similar story, although things aren't quite as bad as they were a year ago. The revenue per subscriber down to $7.31. That's down 4% on a US dollar basis and 2% on a currency neutral basis. So even on a currency neutral basis, in APAC, revenue is down. So not the same pricing power, but we are seeing more members. So they must just be coming in at a lower pricing tier, maybe that ad supported tier. So kind of a tale of two cities, if you will, at Netflix. Ton of strength, both financially, what they can charge, and the number of subscribers growing in North America. Not quite the strength in pricing in the rest of the world, but the subscriber numbers are increasing.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
The challenge now for investors is simply, what do you pay for Netflix? I think strategically, Netflix is in a phenomenal position. We're seeing them start to turn some of those knobs that they have ability to, particularly increasing prices in North America. We've seen that if you are a subscriber to Netflix over the past few years, it's $1 here, $1 there, but that price continues to march higher. The question is, I don't know how far you can push that. And we're starting to see that in the rest of the world, that consumers are moving to some of those lower tier plans. That maybe limits the company's growth from a revenue perspective, because there is going to be a limit to how much people are going to be willing to pay, especially when you get to some of these numbers like 280 million subscribers. That means you're reaching real close to every single household that you possibly can in the world. So let's just go through some of these valuation numbers, try to put this into some context. Price to earnings multiple on a next 12-month basis. So this is based on analyst estimates for the next year, 33. Enterprise value to sales is 7.6. So that's a really expensive stock. Analysts are also expecting revenue growth of just 13.5% over the next 2 years. That's kind of what Netflix is guiding for as well, kind of in that mid-teens number. So still a growth company, but I think the challenge is right now, not a no-brainer price for Netflix. And that is just hitting the scale that they are as a business. Yes, you can be a huge and dominant business, but how are you going to grow 20, 30, 40%? How are you going to, over the next 5 years, triple or quadruple the size of your business when you've already kind of maxed out the number of subscribers that you have and the price that you can charge for them? That's really the tension for me as an investor. So really good results for Netflix, but I'm not buying the stock just because I don't see the price as being particularly attractive. And we have to disentangle those two things. Great company, phenomenally well positioned strategically. They're doing all the right things as far as maximizing their revenue per user, but that doesn't mean that it's a no-brainer stock with asymmetric potential. And that's what I'm looking for. How can a stock 10x in value over the next 10 years? Netflix has done that, but that tailwind is largely behind them. And unless they move into new markets like sports, and I'm talking about getting big into sports, which they have not done yet, or somehow moving into gaming and do it in a much more serious way, which I don't think that's a huge needle mover for them. I just don't see this as all that attractive an entry price point for Netflix. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.